Okay, let's dive into this. Welcome to the Explainer. Today we're decoding a really fascinating financial instrument, the Abacus FCF International Leaders ETF, which goes by the ticker ABLG. We are going to unpack exactly how this fund sifts through literally thousands of international stocks to build its portfolio, all by zeroing in on one very specific, unfakeable metric. But, before we get to the fund itself, I want you to stop and think about this question. What if the corporate earnings reports you rely on are actually misleading? The reality is, a lot of traditional valuation models, things like the dividend discount or discounted cash flow models, they rely heavily on projected cash flows and accounting opinions. Basically, they rely on GAAP earnings, the standard accounting rulebook. But as you'll see, standard earnings actually leave a whole lot of room for interpretation. And relying on them, well, it can sometimes lead investors straight into a trap. So here's our roadmap for this explainer to take us from the dense accounting theory all the way to practical portfolio construction. 1. The flaw in traditional earnings. 2. The free cash flow factor. 3. How ABLG actually filters stocks. 4. A look inside the portfolio. And 5. Comparing ABLG to its peers. Section 1. The flaw in traditional earnings. To really understand ABLG's strategy, we first have to look at the exact problem it's trying to solve. It all boils down to this fascinating concept called the accrual anomaly. This was first identified by a researcher named Richard Sloan way back in 1996. The core idea here is that a company's reported earnings are really made up of two distinct parts: real cash flow and accounting accruals. Now, real cash flow is an undeniable objective fact. Accruals, on the other hand, they're highly subjective. They are open to management manipulation based on whatever accounting methods the company chooses to use. The data actually shows a strong negative association here. Firms with high levels of accruals often end up underperforming because their reported earnings just don't match the actual physical cash they're generating. For us as investors, this means blindly trusting a company's standard net income can be a massive trap. And this brilliantly illustrates the core philosophy of FCF Advisors, which is the research engine behind the ABLG ETF. When you are looking at traditional earnings-based metrics, you're essentially looking at an opinion, right? It's subjective accounting. But when you strip all that noise away and focus purely on free cash flow-based metrics, you are looking at undeniable fact, actual measurable cash in the bank. The research basically proves that free cash flow is a wildly superior indicator of a company's true profitability compared to standard net income. Section 2, the free cash flow factor. Let's look at the solution presented by FCF Advisors. When you look at historical performance cycles, like over a 35-month stretch, portfolios with low accruals demonstrate a massive, consistent advantage. By low accruals, we mean companies where the actual tangible cash flow very closely matches what they are reporting in earnings. They drastically outperform high accrual companies. Low accrual firms are tied to real physical earnings, and because of that, the historical data shows they generate significantly higher market returns on their assets over time. Which leads us directly to the core metric powering our featured ETF. According to their white paper, the FCF Advisors free cash flow factor combines free cash flow with accruals to identify stocks across global markets capable of generating both strong and sustainable profitability. That right there is the secret sauce. It's not just about looking backward at the cash they made today, it is about combining that hard cash data with accrual analysis to predict the truly sustainable profitability of those companies tomorrow. Section 3, how ABLG filters stocks. Let's move to and see how this builds from pure theory into an actual tradable strategy. So how exactly does ABLG will down the massive global equity universe? Well, it works kind of like a giant funnel. Step 1, their quantitative model ranks international stocks globally based entirely on those proprietary free cash flow measures we just unpacked. Step 2, they apply very strict negative screens to filter out the bad actors. Step 3, the model selects about 150 of the absolute highest ranked stocks and weights them using a modified market cap basis, heavily factoring in their free cash flow. But wait, it doesn't stop there. Step 4, the portfolio manager steps in and applies tight discretionary oversight to shrink that list down even further. Now, those negative screens in Step 2, they are absolutely critical to how ABLG selects its stocks. They actively throw out firms that are highly leveraged. They exclude companies that take on debt simply to buy back their own shares. The ones artificially inflating their value without any real underlying growth. They boot out ESG laggards, and notably, they completely exclude the entire financial sector. Why? Because banks and financials have wildly inconsistent free cash flow calculation standards, which basically breaks the quantitative model. So, they're just out. Section 4. Inside the ABLG portfolio. Let's look under the hood. So the crucial point is 52. Despite starting with thousands of global stocks, and even after the quant model narrows it to 150, the active portfolio managers concentrate this fund down to roughly 52 to 55 individual holdings. It is an incredibly convicted, highly concentrated portfolio. To put that into perspective, the top 10 holdings alone make up nearly 40% of the fund's total assets. And because they entirely exclude financials and aggressively target cash-rich companies, the sector breakdown is heavily skewed. A massive 33% of this fund is allocated just to the technology sector. That's followed by industrials at around 19%, communication services at 11%, and basic materials at 9%. This isn't an accident, it's a deliberate structural drift away from what you'd see in a standard broad market international index. When we look at those top holdings, we're seeing some serious global heavyweights that are just absolute cash-generating machines. The number one holding is the Japanese semiconductor equipment maker Advantest. You've also got Taiwan Semiconductor, pharmaceutical giants Novartis and Roche out of Switzerland, and the luxury powerhouse LVMH. These are the specific, undeniable international leaders that actually survive ABLG's grueling screening funnel. Section 5. Comparing ABLG to peers. Let's shift perspectives and see how this actually competes in the broader ETF marketplace. Now, what's really interesting about this slide is the hard performance data over a 5-year stretch. ABLG, carrying a 0.54% fee, achieved a 5.6% compound annual growth rate, so it did slightly beat the broad passive Vanguard baseline index, VEU, which sat at 5.0%. However, ABLG actually trailed the iShares Quality Factor ETF, IQLT. IQLT delivered a 7.3% return while charging a much lower fee of just 0.30%. And based on this comparative data, Koala Gains assigns ABLG a competitive rating of underperform. Their analysis essentially points out that while the underlying free cash flow theory is totally sound, the real-world retail vehicle faces some pretty stiff hurdles. ABLG has a tiny $16 million in assets under management. That results in extremely low daily trading volume and wider bid-ask spreads, which basically means hidden costs for everyday retail investors. When you combine that liquidity friction with a higher expense ratio and that heavy single-name concentration, it just struggles to outpace cheaper institutional-grade factor funds. We also have to talk about risk, especially if we look back at the 2022 global equity correction. Because ABLG is so highly concentrated in just over 50 names, its drawdown profile was actually slightly steeper than its broader, cheaper peers. ABLG fell 16.5% that year. Compare that to a 16.0% drop for the broad VEU index and a 15.2% drop for the sector-neutral IQLT fund. As they say, concentration definitely cuts both ways. Which leaves us with one final, provocative question to ponder as we wrap up this explainer. FCF Advisors makes an incredibly compelling, mathematically backed case that free cash flow is simply a superior metric to traditional opinion-based earnings. But as an investor, you really have to ask yourself, does the theoretical edge of a highly active, heavily concentrated cash flow strategy like ABLG actually outweigh the proven historical benefits of cheaper, highly liquid index funds? It's a fascinating debate between pure quant theory and market reality. Thanks so much for joining me on this explainer, and I hope this deep dive helps you as you analyze your own portfolio strategy.